All right, let's dive into what's easily one of the most confusing, completely paradoxical setups in the entire market right now, Kraft Heinz. Welcome to this explainer where we are going to unpack a massive $30 billion mystery. Right now, this consumer staples giant is flashing some incredibly deep value signals, but also some absolutely massive warning signs. And, if you aren't looking at the underlying data, you are totally missing the real story. Because on paper, this company is bleeding heavily. Kraft Heinz is posting a staggering trailing 12-month GAAP net loss of $3.4 billion. I mean, if you were just skimming the headlines, this looks like a fundamentally broken business. A negative $3.4 billion hole is literally the kind of metric that sends most investors running for the hills.
But get this. At the exact same time, the company is an absolute cash fortress. They're generating $4.62 billion in operating cash flow. So you've got to ask yourself, how in the world does a company lose over $3 billion on paper, but still rake in nearly $5 billion in actual, tangible, cold hard cash? Well, that right there is the Kraft Heinz paradox.
To find the truth behind this massive disconnect, we are going to make sure we cover all the points by running Kraft Heinz through the ultimate valuation gauntlet. First, we'll hit the valuation models. Second, we'll expose the media blackout flags. Third, we'll run a legendary reality check. And finally, we'll give you the ultimate verdict. Okay, let's jump right into phase one, the valuation gauntlet. The absolute most crucial point here is figuring out what this company is actually worth, especially since traditional earnings metrics are completely distorted by that massive paper loss we just talked about. So we synthesized 21 different financial models across 5 distinct groups: cash flow, dividends, sector multiples, hard asset value, and real options. And when you do that, a remarkably clear picture starts to emerge. Look at Group A. The discounted cash flow models land between $28 and $36. Group C puts sector multiples as high as $38. And Group D, which is the actual replacement value of those massive global brands, that ranges from $28 to $40. So even factoring in a super conservative dividend model, the floor here seems remarkably stable. When you synthesize all 21 of those approaches, it yields an average intrinsic value range of $26 to $34 a share. Now compare that to the current price, which is sitting at just $25.51. Across almost every single metric, the stock appears undeniably undervalued, trading at a 10 to 20% discount to its blended intrinsic value. But as we all know, a cheap stock isn't always a good buy. Which brings us to phase 2, the media blackout. Looking at the red versus the green flags.
Let's pit those brutal headlines everyone's reading against the actual underlying financial reality. Now, the prosecution's case is heavy, and these 7 deep red flags are glaring. Remember that $3.4 billion gap loss? Well, it's driven by a massive $7.4 billion non-cash impairment charge in Q2. Basically, management had to come out and admit they wildly overpaid for past acquisitions, including the Kraft Heinz merger itself. Ouch. But it doesn't stop there. Organically, sales are down 1.3%. Gross margins actually contracted by 200 basis points. That's a full 2% drop due to inflation. And their biggest profit engine, North America, is in a 2.7% free fall. Plus, adjusted operating income plummeted over 18%. And sure, that incredibly low beta of 0.08 might look like a safe harbor for market volatility, but honestly, it's really just masking stagnant growth and some deep existential risks from private label competition.
But the defense counters with data that the media is completely ignoring. What's absolutely striking here is the price-to-book ratio. The stock is trading at 0.84 times book value. That means you are buying it at a 16% discount to its actual book value of $30.36 a share. That is an incredibly rare opportunity in the consumer staples sector. On top of that, it boasts a phenomenal 123% free cash flow conversion. That $4.62 billion cash fortress we mentioned, it covers their massive 6.27% dividend yield more than 2 times over. And yeah, while North America might be struggling, emerging markets grew by a fantastic 10.4%. Plus, the debt is highly manageable, sitting at a 5.9 times interest coverage ratio. All right, let's move to phase 3, the legendary reality check. We've got this incredible tension right now between the red and green flags. So let's see how the greatest value investors in history would grade these exact numbers. We'll start with the father of value investing himself, Ben Graham, who would absolutely demand we look past all this market noise and focus directly on the hard assets and the math. So how does Kraft Heinz fare on Graham's scorecard? Well, it's a split decision. Graham would absolutely love the idea of buying 50 iconic consumer brands at a 16% discount to book value. But there's a catch. The famous Graham number requires positive earnings to calculate. Because of that $7.4 billion impairment creating negative GAAP earnings, he'd fail it on the bottom line. He'd definitely be tempted by the assets, but very cautious of the distortion.
Growth expert Peter Lynch, on the other hand, he would completely reject it. Lynch's golden rule is finding growth at a reasonable price, which usually requires a PEG ratio under 1. Kraft Heinz has an abysmal PEG ratio of around 5. Combine a forward PE of 12.44 with an incredibly sluggish 1 to 3% growth rate, and Lynch just walks away instantly. To him, low single-digit growth plus negative GAAP earnings is a total non-starter.
Next up, we apply the Warren Buffett framework, which is perfectly fitting, right? Since he actually helped orchestrate this merger in the first place. Buffett focuses on whether we're getting a high-quality business at a truly fair price.
On Buffett's scorecard, things get really interesting. If you strip out that one-time $7.4 billion impairment charge, the adjusted owner's earnings represent a highly attractive yield of around 12%. He would see exactly what we saw earlier, a massive cash-generating machine. But here's the rub. Buffett demands exceptional capital allocation, and Kraft Heinz's return on invested capital is sitting at a weak 8.05%. That is well below his 15% required threshold. Basically, he likes the cash, but he really hates the capital efficiency.
Okay, bringing us to phase 4, moat and final verdict.
Let's bring all this conflicting data together. Despite the financial turbulence and those really ugly GAAP losses, Morningstar confirms that Kraft Heinz still possesses a wide economic moat, and this is built on 3 main pillars. First, intangibles. They own over 50 iconic heritage brands. We're talking Oscar Mayer, Philadelphia, Velveeta, brands with a century of consumer trust. Second, switching costs. There is intense recipe loyalty among consumers. And third, efficient scale. Their massive global manufacturing and distribution networks are simply way too expensive for a newcomer to ever replicate. So what is management's master plan here? Well, they know the foundation is cracking, which is why they're initiating a massive turnaround catalyst. Set for July 1, 2026, they are rolling out a 3-region restructuring plan, breaking into North America, Europe/Pacific, and emerging markets. Crucially, they are backing this up with $700 million in incremental brand investment. They need to fight off those private labels and widen that competitive moat fast.
So here is our final verdict. We've got a classic paradox on our hands. The stock is undeniably cheap. At 0.84 times book value and an 8.5 times forward EV to EBITDA multiple, the sheer cash generation makes it look like a screaming buy. Plus, you're getting a 6.27% dividend yield that is perfectly safe. But the operational trends say wait. The underlying business is facing real volume decay in North America, serious gross margin compression, and let's not forget, they just had to wipe $7.4 billion of value off their balance sheet to account for past mistakes. With the 21 valuation models screaming undervaluation, but the operational realities flashing bright red warning signs, the ultimate question remains, is buying Kraft Heinz at a 16% discount to its book value the deep value play of the decade? Or are those eroding margins and sluggish growth rates proving this is just a classic value trap? The numbers say buy, but the trends say wait. So which side are you on? Take some time to think about it, dig into the data, and as always, do your own homework. Thanks for joining me on this explainer, and I'll catch you next time.